real quick. Cool. That should be going awesome. This week, my main focus wanted to be on getting an overlook of the sectors. So it'll look a little bit different than previous weeks as far as breaking down an entire watch list or looking at SPY, Qs, IWM, and then the three individual stocks. I wanted to devote all of this meeting time specifically to just looking over these sectors and kind of giving you all a glimpse of how I go about narrowing down what I want to look at and the reason why I've stayed within specific sectors the past few weeks and how to build off of the understanding that we started to build the last few weeks as far as where you're getting money flowing in and out of and how to take advantage of the potential to foreshadow some of these movements. So that is really the heart or the big emphasis behind the way that I decided to structure things this week, and also with the intent actually to give you a little glimpse or to give you a little bite of what next week's lecture and info will cover. Because if you take a look at the course schedule or the syllabus, the upcoming week focuses on the market sectors and sector rotation. So I won't go too in depth into all of them, but it's going to be a mixture of the intro of it and then more wanting to focus on the chart itself. So I won't give you an entire breakdown of this is the whole sector, this is how it functions, things along those lines. It'll just be a quick intro into it with hopefully more of a focus on the charts, because my intent or my hope is to go through all or the main 11 areas that we have access to. We won't necessarily break down every single chart to the extent where we'll have targets for every single chart. It'll more so be looking at the overall trend momentum that we're seeing in relation to some of the data that we'll go ahead and pull up throughout our conversation. But to kick things off, before we actually start going into the charts, we'll go ahead and look a little bit into sector rotation and what exactly is the emphasis behind it, or why does it even matter, right? When you're looking at sector rotation, it is the movement of capital from one sector to another as conditions change, as market sentiment changes, as we see things develop, like all of the macro um, data that we covered in last week's session. How does this all impact market movement, right? So now we're going from cause to effect type of understanding, and typically you see sector rotations start to occur in anticipation to future conditions, not just a reaction, right? So this is where we get to potentially benefit from or gain some sort of edge, is in the understanding that smart money institutional investors, to an extent, have a bigger understanding or a wider outlook on things than we do most of the time. So sector rotations happen because in advance they're already moving money. So that our hope is to catch some of that movement and to ride on those coattails, right? And to take a small piece of the pie or whatever we're able to take. So it is of interest because sector strength often precedes that macro data that we talked about. It helps traders align positions with momentum. That's definitely a big thing to keep in mind when we're talking about those big gains that you often see being posted online and things along those lines. A lot of it has to do with the momentum or the current strength within a specific sector that led into interest in that specific name or stock ticker that you might be looking at. So rotating into other things like defensive sectors is also a way of protection, right? So there are ways or that sector rotations occur in order to be on the attack or on the defensive side of things. And on the right hand side here, you see a breakdown of the main sectors within the market, which are energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, or just tech in general, communication services, utilities, and real estate. These are the main ones that we'll go ahead and cover throughout today's meeting. And then what I wanted to focus on or wanted you all to start building an understanding of as we connect data or information from previous weeks into the coming weeks are the economic cycles, right? Remember, last week we covered the business cycle as a whole, as far as what do these cycles look like within a specific organization. So in relation to that, start to take a look into the economic cycle as a whole and how the economy tends to move and what current or what specific fields tend to do well in certain conditions, whether we are experiencing a full recession. This is when you have GDP retracing quarter over quarter. You have interest rates falling, consumer expectations and sentiments start to hit lows, right? As far as how we're feeling about making purchases, holding money, and things like that. Yield curve and how that's being affected. So some of the main industries, fields that we see become emphasized or that hold strength within a full recession tend to be the utilities, things like healthcare, consumer staples, because these are things that no matter what conditions, they never go away, right? We need the healthcare industry no matter what type of condition the economy is in. People are always going to need some sort of healthcare, whether it's on the pharmaceutical side of things, whether it's on the health insurance side of things. That's why relatively the sector tends to be rather stable, and we'll dive into what that means or what that looks like within the charts and the candles themselves. You have utilities. We all need water. We all need gas. We all need um, well, what's the other one? Waste services, right? To operate locally and nationally. So these are things that are always needed. Whether you're thinking of utilities on the services side of things or on the raw material side of things. And then overall consumer staples, right? Those that are day-to-day products, Procter and Gamble, when you think about Coke, Pepsi, when you think about UPS, these things that traditionally the not only like the consumer, but at government level also can't operate without. When you are taking a look at things like after a full-on recession, the beginning stages of a recovery, this is when things kind of start to pick up, but you're still a little weary. You get some sort of interest going then now into consumer discretionary. These are the things that we don't necessarily need, but people like to spend money on, right? Like the luxury goods. You start to see financials turn around because remember, financials, the banks, when you're in contraction, when you're in a recession, what typically happens? Or when you're in a contraction before you head into a full-on recession. Interest rates are being driven up. It's cost a lot more to borrow. So you're in a period when you experience that stress, and now you're going to expand from that contraction, and interest rates, like stated in the full recession part, are now hitting lows. So now it's giving the consumer more reason to say, well, if interest rates are so low, then I might feel comfortable enough in taking a mortgage out and buying a home or buying a car, right? All of these different opportunities to buy with very low interest. So that's where you see the banks or the financials expand. Industrials you start to see a lot of interest in, because very similarly to the financials or the banks, it's on their end. Not only are they getting to benefit from the low interest rates, but these are the production heavy organizations, right? When you think about some of the opportunities like CAT or Triple M, or all of these companies that produce goods that are needed by almost every other sector, right? So when you think about why is Triple M, I don't know if you all know like too in depth of what the organization is or what the company is, but why has it historically been pretty stable, other than the lawsuits and stuff that they had to go through a few years ago? They not only they produce tape, gear, all of these things for the construction field. They produce a lot of adhesives. So some of the adhesives that are not only used during like the building process, but they could also be the adhesives within your phones, within just the day-to-day tech that you use, things along those lines. So the industrials overall, great opportunity, or that's where you start to see like the production ramp up again. Mid to late expansion, so as you're in the midst of growth, this is where tech sees its biggest benefit, right? And this is also where communication services sees its biggest benefit. And the way that I look at these kind of go hand in hand, right? Because some of the bigger parts or holdings of the communication sector are also big tech companies like Meta, like Google. Can even include Netflix and some of the streaming services in there, because those are technically lumped into the communication sector as well. And then you go back to the opposite end of the full recession, or the step before it, late expansion to early recession. This is when the market again starts to feel that not overwhelming just yet, but the feeling of like, oh, we might be reaching highs, or these prices don't really seem justified, or interest rates are really ramping up now. So I don't feel too comfortable getting that mortgage, or I don't feel too comfortable purchasing that new vehicle. Right. So this is where you start to see benefit in things like the energy sector, materials, raw materials specifically, and real estate as a safety net, right? Tends to hold its value rather well over time. So as you start to think about all of these different cycles and the sectors that you can potentially benefit from within specific cycles, and you can play them both ways, right? Just and I say that because you have the opportunity to short the market as well. So if you are in one of these periods where a specific sector isn't really benefiting from that current period or point in the cycle, then you have the opportunity to short those that aren't of benefit, right? So definitely things to keep in mind, the different ways that you can play the market or execute based off of your understanding of what's going on, or what current cycle we might be in, or what stage we're heading into. Sweet. So before we start going into, I promise we're going to get to the charts. Before we start getting into it, one of the things that I would love to cover and give you all an understanding of how might you be able to speed up the process, because it's very time consuming and labor intensive to be going through things from chart to chart, right? And chart every single thing out there, and then go through them and like compare the percentage change, which is perfectly fine, right? That's how I started doing things. Like I and you'll see through our presentation today what I mean. Like you can go year to day, sector by sector, and see what that percentage change has been. You can see what the percentage has change has been within the past month, within the past quarter, and compare sector by sector based off of those. But if you want more of I would say like a cleaner look at things as far as how to be able to compare them all at once or to see how the market is moving, right? If you want a visual representation of it, I really encourage you to take into consideration relative rotation graphs or RRGs. These are, it's a great graph to have, but a lot of the data or the platforms that present this data visually to you that you do have to pay. But I'll go ahead and show you something that I do whenever I get ready to do or go through these quarterly and monthly sector breakdowns. Because typically what you'll see me do is I'll provide an in-depth monthly sector breakdown. So I need to catch up on those, and then a quarterly one which is a little bit more in depth as far as the overall rotation. So the RRGs, they're literally showing you what's weakening, what's strengthening, and it does break this up into four different quadrants. When you take a look at the graph, it'll show you the leading sectors, the weakening sectors, the lagging sectors, and the improving sectors. Have you all taken a look at relative rotation graphs before?
I haven't. I'm actually trying to. I have Trading View, so I'm looking for them right now.
Okay.
So yeah, I will. I will soon.
Cool. And the reason that I ask is because, and I don't know if you do find it on TradingView, let me know. I don't know if they have it, but there's a specific company that I think leases the API out to different organizations. So it is, I don't know why it's not something that's like really readily available because I've never been able to find these um, on on Webull, which is what I predominantly use for charting. But I'll go ahead and bring this up. Are you able to see this now?
Yep.
Cool. Okay, awesome. Just want to make sure you're able to see the graphs here. So this is on stockcharts.com. I don't use stockcharts.com to chart at all because to me it's very clunky the way that charts work here, and it's also a subscription service. So I don't really use this for anything other than looking at the relative rotation graphs. They do have a monthly trial, so that's what I typically do is I'll just create, like a new email and just do the monthly trial and do my analysis, and then I'll end the trial. If you do want to pay for it, it's like I think like 20 or so dollars, but I'm not trying to like advertise it because I don't pay for it myself either. And really, this is the only or the main thing that I see of value in this specific um website. But I love to use this because you can, let me see. I'll actually bring all of them off. So what it's doing here is it will show us all of the essentially the sector performance in relation to SPY, right? You see SPY listed up here. I have that as my benchmark here. You can do anything else. So you can use a benchmark of XPX. And actually, it's dollar XPX if I wanted to use that, which is the same thing as SPY. You can use it in relation to anything, right? If you wanted to compare in if you wanted to compare the chip sector. So you can use NVIDIA as the benchmark, and then here where it has the add symbols, you can add the symbols for all of the other chip companies, right? And you can see which ones are leading within the chip sector, which ones are lagging, and potentially catch one of the laggers as the rest of the field increases, right? But what we're looking at here is the overall market. So I have it by a weekly period, and if you take a look at it here, I have currently listing 30 weeks. So see how if I go to zero, this is where they all were 30 weeks ago. So then if we just go week by week, it'll show you the progression of these sectors week to week and where they are now as of Friday, right? As of May 2nd, um, over a 30-week span. And that's pretty extensive. So I will actually, if we want to take a look at the daily, I'll go ahead and save that. And this is just the change in the past 30 days now, right? You see SPX 30 trading days ending May 2nd. So that's what I wanted to mainly focus on today. And the reason why I'm using SPX or SPY as the benchmark is that that's essentially that's the overall market, right? Or that's the leading ETF that the majority of the market is looking at. And what I did here is I listed all of the sectors. So XLE, XLB, XLI, XLY. What are all of these?
Sector ETFs.
Yeah, and there's specifically spider ETFs, right? So if you take a look at SPY, that's a spider ETF. So that's like the organization or the I'm forgetting what the term is for the person or the organization that creates the indice. Um, so you know how Q's is Invesco. I forget what's TAN or what's BETO, but these are all of these ETFs are also under the organization that oversees SPY. So that's why I'm using these specifically because you could use the which one's the equivalent of SPY? It's like VOOO, right, or something like that. If you're taking a look at the Vanguard ETF, so depending on what you're looking using as the benchmark, you might need to to list the appropriate ones because if you're using the Vanguard ETF equivalent of SPY, then you're going to want to use the Vanguard equivalent of energy, of healthcare, whatever it might be. But these are the most popular ones or like widely used ones with the most volume traded on a daily basis. So that's why I'm using these. I just wanted to make that clear. So if we take a look at this, it's exactly what we talked about, right? The blue shows us those that are in the improving side of things now. Green are the ones that are currently leading. Yellow are the ones that are weakening. Red are the ones that are lagging. But what you want to take into consideration is in what direction or how they've been moving. And I say this because energy, as you can see, as we went into the last week, energy was improving. And that's why XOM has been on my watch list. But based off of the past 1, 2, 3, 4, 5 trading days, it looks like energy could be reverting back into to lagging. So depending on certain conditions, certain stressors, it doesn't mean that it'll keep going in the same direction, right? That you potentially see it going in. I guess is what I'm trying to emphasize here is that yes, traditionally you see the cycle go in a full circle moment, right? But it doesn't always work like that. And I bring this up specifically because especially if we take a look at tech specifically, right? Let me bring some of these off so we can emphasize some of the conversation that I'm trying to bring up. Cool. Oh, I don't know what I did. Oh, it's not showing me full now. Oops. There we go. I just hadn't clicked on it. So if we take a look at XLK specifically, it took a month. It went from improving, right? It dipped back into lagging and then went back and is now in the leading. So within like a 2 weeks time frame, it just revolved around improving and lagging before it the last what is this 1, 2, 3, 4, 5, 6, 7, 8, 9. So but yeah, about like a week and a half, it now went back to improving. So a lot of this has to do with the current market conditions, right? And tariffs and everything that we're seeing. And you also want to take into consideration what the X and Y axis here are actually telling you as well, right? As far as the overall momentum. So the closer you are within these four squares, the momentum isn't really there. So the closer you are to here, the quicker you'll shift in one direction or the other, right? But the further you're away from it, it shows greater momentum within those areas. So I would feel more confident in going long for an extended amount of time within a specific tech name if we saw momentum higher up here, right? Telling us that there is overall strength there. Overall, like it's telling us, yes, that there's strength, there's momentum there. It's already been improving or it's been leading within the past 1, 2, 3, 4, within the past week. But can anybody or is anybody willing to take a guess as to why we've seen a strong week, week and a half within tech in the past in that past week, week and a half? It's been because of earnings.
Earnings? Yeah,
Yeah, yeah, yeah. Sorry, I beat you to it by a second. But yeah, it's because of earnings, right? That was definitely a big thing that that lifted us or that kept us um, going from improving over to leading. But as you can see, the momentum's been stable, right? It's been stable, but in relation to the overall market, where some of the market has experienced stress, this has just kept stable. It hasn't increased drastically. But as others have gone from weakening to lagging or slightly improving, this has now been the leading sector because it's seen the largest influx of money, of volume, of momentum into it. And it's been because of earnings. So that's something to keep in mind because if earnings in PayPal, Meta, Google, Microsoft hadn't gone as they did, then this would have, instead of going into leading, it would have sharply gone down, right? Or it might have even just came back to lagging without going into a leading phase or a weakening phase at all. So what I'm looking at in the next week or so is, does momentum hold up, increase here? How does the market digest those earnings reports now being a few weeks removed from it, now with the understanding that Amazon has lowered guidance moving forward for the next quarter, and the barely beats of Apple and how they're potentially facing a certain amount of tariffs and things like that. How does that play a role into how long or the momentum being built within a leading period specifically? So if we bring up the rest of the sectors that we have here, and let me make sure they're all highlighted or not highlighted. Is that easy to see, or is it better to make sure we highlight all of those? I know they kind of all overlap, so it gets a little messy. But just taking a look at these, what would be of interest to you? If we're taking a look at these in general, currently the only improving one has been energy. We have healthcare and materials lagging, right? They currently find themselves here, but with the understanding that materials actually went from leading sharply back into lagging. So it had no momentum that kept it within the leading stage. And currently we have one, two, three, four, five different sectors that are being considered as weakening. So when you take a look at five being within the weakening stage and two more being within the lagging stage, what does that tell us? If seven out of the 11 sectors aren't necessarily within the improving or leading stages, at least in the past month. It just shows overall market weakness, right? Or uncertainty that we are waiting to see how we can potentially either rebound or stabilize from what we're currently experiencing. And in reality, when we take a look at these two, the energy sector and the communication services, communication has had little to no momentum, right? Taking a look at that specific sector, it's just been stable. And it's been stable around here because, again, in large part, the communication sector is propped up by tech as well, with some of those bigger names being Meta and Google that also play a big part in communication, right? When you think about Google offering their internet services, their phone plans, things along these lines. And on the meta side of things, just the fact that it holds such large consumer data and the use or the arms that it has within communication specifically. So it's really had little to no momentum, but it's been propped up by those earnings reports as well. Do you all have any questions about these graphs? And does it make sense why I use them or like the benefit in using these types of graphs?
Are they also called or associated with the relative strength scatter plot?
Yeah,
Okay, okay, I'm getting closer to finding them on TradingView.
awesome. And like I said, when if you do, just let me know. Because I know that they'll be called different things
Right.
in different platforms. And if you don't need to like pay it or make like keep making like monthly trials, then there's definitely like no need to do that. So I really encourage you to definitely look for it. But if I'm not mistaken, that should be it. That should be a name for it. So, and really that's all it is. It is a I say that's all it is, but to me, it's a pretty impactful tool because it's showing you that visual representation, right? Instead of you just having to go and say, well, year over year, this sector has outpaced that sector, or it's underperformed it, or month over month, it's done that. It gives you that visual representation, and it's just a little bit easier to potentially see where things might be going. So based off of where we're at currently within the past month, again, I am really interested in energy. And seeing where that holds up in relation to tech, really interested in the healthcare industry, and that's why we had Johnson and Johnson on our watch list not too long ago. Kind of interested in the industrials. That's why we had HON. Financials have held up really relatively well, although they have been weakening. You kind of see them going into this lagging phase where you can potentially get in early enough to then catch a pop as it moves into improving or potentially leading phase. So definitely something will go more in depth as we move forward, especially next week. So I don't want to bog you down too much with it. I know that I spent a little bit more time than I intended on that, but I wanted to give you a
think
glimpse. Yes.
I think I found it here.
Sweet.
Here's a little visual representation. It's just going to be my webcam at my screen right now. I don't know if it's too glary, probably.
Oh,
But yeah,
I
if
can
you
slightly see it though.
um, I don't know if it's going to focus or not. But anyway, anyone that has TradingView, I'll send you what this is called. But basically, it's relative strength scatter plot, but the official kind of like has like a custom name. You probably can't see because it's all, but I'll put all the information in the chat for anyone who
Sweet.
uses TradingView. You can put your inputs, anything you want. So yeah, I'll post all that info.
Awesome. And can you use that with the free plan, or do you need the paid plan for it?
Um, I think I have the medium. It counts as an indicator. So
Oh,
if
okay,
you
cool.
have room, so yeah, if you have a free version, you have an extra slot for an indicator,
Yeah,
you can definitely get it for free.
awesome. Cool, cool. Thank you.
Yep.
Sweet. So now I wanted to start diving into the sectors and look at the those charts specifically. So we'll just go one by one, and that's how we'll really lead into the end of today's meeting. Let's go ahead and pull these up on my end. So starting off with XLK, this is the overlook of technology, right? In the past week, you saw a rebound of around 4% or a little bit under that. It was led by strong earnings, like we talked about. Microsoft, Meta, beyond that, Google and these other companies like Apple. But what we need to take into consideration are the impacts that they're facing, right? So the nearly 900 million in tariff related cost. What does that look like when you're talking about being propped up by device sales for the most part, right? Because unlike Amazon, where Amazon's business largely comes from the cloud services and not necessarily the products that they sell off of their website per se, then what does it look like for a company where the majority of the profit does come from the product sales that they produce? So if we take a look at the year to date performance, tech specifically is down almost a little bit over 6.5%. So that's definitely something that we need to keep an eye on long term as far as the potential for a rebound, right? Because technically it is down. Tech is down, although we're still hovering within these all-time highs in comparison to where we were a year ago. Right there's lots of potential opportunity to benefit from this sector specifically, or just seeing where things go. When we take a look at it, let me bring it up. Mm, Give me a sec here. I'm actually moving my share. You should be able to see my chart now. And I meant to say year to date, not year over year. So that's something that I uh sometimes confuse myself about. But the chart that we were seeing, the 6.62% um retracement, it's year to date, right? Not year over year. Exactly. So that's definitely something that I wanted to emphasize. But when we take a look at the chart here, I know that in previous charting sessions we've talked about where do you like find your specific levels that you might be targeting, or how do I break the chart up? Like I always said, I do start on the weekly chart, and I'll give you a breakdown of what I want to go into within every other chart as far as potentially speeding up the process for yourself or making it a little bit easier, because typically I'll do the same thing, right? As always, I'll go ahead and break up my chart into different sections. So I know, or ranges, specifically is the term that I like to use, that I've been using. So all-time high right around here. I chose this specific level because we have a few areas where it became a roof, right? So if we take a look at this initial area here, take a look at it here, the fact that it's bounced twice here, and then it used it as a rejection, and now it's a level that's being acting as a magnet for that, right? And then the top, there's just all these candles here. And you're never worried about like getting these levels to the exact cent. That'll never necessarily be the case. That you'll find over time, like they'll become a lot more refined, or you'll be able to pick up on these a little bit better. So they'll get tighter, and a lot of the times it will react to the scent based off of where you put it. But more often than not, it won't, right? So don't necessarily stress out about getting these levels on the dot to the exact scent. Focus on the ranges that are being built. So, and I'm just going to go through this fairly quickly just to do my general breakdown of these ranges, and then I'll show you something else that you can potentially use before I even put any sort of zones, right? Because I was already tempted to do that. I could have um, done something like this, right? This could be a lower zone that I've been eyeing here, things like that. But this is how I like to work it as far as going from like top down, getting those general levels. There's a few in between, right? Like this area here, potentially. In between, I could use this level here, but I won't really use it right now. I could put one around that area as well. So then, and like I said, I'm only going weekly and 4 hour. That's my main focus. You can go daily as well. It's beneficial, but I want to go from the weekly to the 4 hour. And the reason why I personally skip the daily is because take a look at the weekly, and then take a look at the daily, and in comparison to my 4 hour and levels below. What do the 4 hour, the 15 minute, and the 5 minute show me that the daily and the weekly don't show me?
The intraday, right? Not intraday, but like,
Yeah,
yeah,
that's part of it. Yeah, the intraday, and also the extended hours, right? So what you see here on the weekly, you
yeah,
see
that's
how
what
it's
I'm
just
thinking.
a black background. When I bring it down to my intraday levels, you see the little gray shadowed background. That gray shadow is the aftermarket hours and the pre-market hours. So remember we talked about me always activating those because it gives me more data points to go off of, is showing me where institutional orders are potentially being executed, things along those lines. So I don't really use the daily because to me, I'm using the weekly, and the weekly's already a higher time frame with a strong support resistance level. So I know there's going to be a strong reaction whenever it hits these levels. So for me, the daily, it really is just the midpoint between the 4 hour and the weekly. So I don't want to clutter up my chart. And I know that this is something that I still have to answer within our specific conversation. opt-in as far as the NVIDIA chart and the other one you followed up with, when I stated that when I'm charting top down, and I don't mean just top down from the weekly, like literally top down, but when I'm charting from weekly to 4 hour to 15 minute to 5 minute. Yes, it's exactly what you said. Like if I'm going from the daily to the 4 hour, a lot of these levels are going to overlap, right? When I go to the daily level, where this level here, right, it's a weekly one, and I can see perfectly how it's reacting here to the daily. So that could also be a daily, right? But I already identified it on the weekly, and I know that it's a stronger level as outlined on the weekly. So essentially, what happens then when I go to the 4 hour, it's exactly how you would think intraday works. 4 hour, 15 minute, 5 minute, all of this price action is happening within one of those candles on the weekly, right? Within one of those candles on the daily. So it ends up being that the 4 hour levels or the intraday levels are always going to be found within the ranges that you identified on the weekly time frame, right? And this is what I mean is these are all I'm on the 4 hour now. These are all the levels that were outlined or that we just outlined on the weekly. So now, well, what is my goal? If I'm going to again um, chart from top down, this is that upper range that we identified, right? So I won't go as high as that right now because we're not necessarily touching those levels, but I'll go up to the roof of that range. So if we take a look at my weekly, let's go here, my 4 hour I meant. Let me change meant to change the color of this, right? So we'll go green as my 4 hour. Cool, that doesn't surprise me as far as how price action is being seen here. So let me take a look and bring that over. So that is my supply zone, right? For the upcoming trading week or two is potentially a pop between 225 to 227 within tech specifically, and then just going down again. And right now, again, I'm not taking a look at so much the historical side of things that we talked about last week, right? Where I'm going back a year or so. I'm specifically identifying the current price action. So what's happening within current trend. And I guarantee you it's going to line up with the historical thing, right? So I'm doing this to just give you an idea of what you could do in order to start to get yourself started. So here, right, we saw a bounce there. Actually, before I even out the next level down there, let me annotate this. So we got that bounce there. We got a little floor there, right? So this is the staircase down. So that's showing us something. And then we got the push up before it came back down, down, and then push up, and then down, right? And this ended up creating what it's showing me is a potential, if we're taking a look at patterns, it's that inverse head and shoulders, right? So it's that move back up to the neckline, and then here it's either going to see a big rejection or we're going to get that pop and continue to move up that way. But that's besides the point. I just wanted to outline some of the staircase to show you the areas that are of interest to me and why I might be outlining certain levels here. So, right, we talked about this right there. Then that right there. Let's see. Mm, That's zone for me. Let's take a look. Got the bounce right there. Okay. I know that might have been super confusing, but do you kind of get an understanding of what I mean when your intraday levels are going to be within the range of your higher time frames? So when I had said your when you chart the weekly, your dailies are going to be within the week, your 4 hours are going to be within the day, your 15 minutes are going to be within the 4 hour. Is that starting to make a little bit more sense? And if it doesn't, it's okay. Um, but that's what I mean is that we identified all of these weekly levels as far as the overall the wider range, and then the 4 hour just all those levels fall in between, right? We're just analyzing the price action between that weekly range. That's all it is. So that for me breaks down the entirety of what I'm looking at now for XLK as far as potential targets. My initial target is 225. We have a hold here of around 213.50, right? We could see some slight weakness here as it's been a staircase up, right? We took the retracement here after hours popped. It held yesterday, so it'll be interesting to see, do we retest the weekly again and then bounce, or are we holding here? Because Monday morning, tomorrow, wouldn't be surprised if we opened up, we gapped up slightly at around, I want to say like 219 and then continue to move upwards. And now that we've charted this and I've showed you that, right, I'll go ahead and show you another way with the upcoming chart where you could potentially give yourself a starting point and then build off of it. So taking a look at financials now, let's go ahead and switch over again. We're just going to be going back and forth between the slides in our chart here. Financials. It's been pretty resilient the past week with about a 2% gain. This was specifically supported by strong earnings, right? We had BAC or Bank of America on the watch list about a week ago. It beat its earnings across the board. Banks have been doing well. And one of the biggest factors in banks seeing some sort of stability or like consolidation has been the fact that they have less exposure to the international trade tensions that have been going on. So when we're talking about like tariffs and all of these things, it doesn't completely or it doesn't as affect the bank or the financial sector in its entirety because it's not like Apple, right? Mass producing its product elsewhere in China specifically. So it's not having that sort of impact. So you've seen a lot of money move back into this sector in order to hedge or to shield that potential gain or to shield the overall wealth that they're holding. And year to date, this sector has specifically seen about a 3.2, a little bit over 3% increase. So it has held, it has been somewhat stable. So now taking a look at its chart specifically, very similar to tech itself, right? As far as the type of setup that it is bringing. What I mean by that is seeing just on the naked chart itself, right? The potential for it to follow a very similar pattern where we're potentially building that shoulder. We have that potentially building this. and potentially trading into that. It was pretty bad. Trading into that neckline, seeing if it comes up here and rejects before bouncing again and then breaking up and doing something like this. Or if it just breaks, it
On the
retests.
daily, it has a pretty massive gap that it just did within this last week.
Yeah, which is why I'm very confident in get. And you're talking a gap, it gapped up, right?
Yep,
Yeah.
on the daily
And
at least, but intraday on the 4 hour.
mhm. And this came from that earnings strength. That so overall it's seen that influx because of it. And what we did here, right? And what was interesting to me is that you had this initial gap where it dropped, right? So it was a gap to the downside that we've been trying to fill, and it rejected pretty harshly here at the beginning, or towards the end of April, and then we've kind of just been pushing towards it, and then we gapped up, so that we still don't have like really solid, and I keep saying data, but it's price action, right? We don't have really solid price action within this specific range here. And for me, we're building consolidation because that's something that you also saw within here, right? We're just in these two,
Yeah,
you
it's
can
almost like
consider.
that psychological, like $50 price point.
Yeah, yep, is definitely. I think we're bound to consolidate at these areas, and it's great that you bring that point up because what I wanted to focus on or to give you an idea of where might you be able to start if you're not feeling too comfortable about just charting your levels like we would, right? Or like I traditionally would if we're taking a look at the weekly here. And I just say, hey, well, I'm gonna break down my ranges as I always do, and if that's confusing to you, and if it doesn't make sense why I might be interested in these specific levels, then if you want to base it more off of like something mathematical, right? Because again, all of these, they're literal data points. The price action is showing you where shares are being bought, where shares are being sold, and at what quantity, at what volume those shares are being bought and sold at. So there are tools within your charting platforms that make all of those calculations for you and will show you projected levels based off of potential retracement or based off of potential expansion or extension. Right. And what I'm specifically referring to are your fib levels. Have any of you all, or are any of you all familiar with fib levels? And to what extent might you have been using them?
I'm aware of them, but I don't use them.
Awesome. Okay, yeah. So
Yeah, I use
it's
them quite often.
okay. It's a good tool to use. There are two different ones. Every platform will be slightly different. But what I encourage you is to take a look at what your specific platform might have available to you. And the two main ones that I tend to use, you see here either fib retracement or fib extension. When you take a look at fib retracements, these are used to pinpoint areas where price action might pause or reverse within a certain trend, right? Or a certain extension. While the fib retrace or fib extension is kind of like the opposite of that to an extent, where fib extension is showing you a projection beyond the current price range. So mathematically, it's telling you based off of the current standard deviations, where might we be able to extend to, right? Knowing that price typically always reverts back to a mean or to an average price point. Right, that's how I digest it or how I perceive it, is that it's essentially showing you standard deviations that you can potentially extend out to or that you can retrace from. So it's tricky, and to me, it's been tricky to develop like a really good understanding of when to use which one or how to use them exactly. But for instance, if we're taking a look at fib retracement, right? Remember that retracement is used to pinpoint areas where price might top off at or reverse within a certain extensionary period. So for instance, if I'm taking a look at the weekly chart here and I see what I think the overall trend, right? Let me actually, oh, I didn't mean to do that. Let me actually move all the way back here.
Gonna say the best feeling in the world is when you set your levels and then you turn the fib on and they line up and you're like, oh my God.
Yeah. Oh, that definitely. So if I'm taking a look at 2020, right, there's various ways that you can do this, but in reality, we've been running, right? So since that 2020 drop. So if we're taking a look, if we think this is a potential top, these are lower levels or ranges that you want to take a look at, right? And I wanted to bring this up because as I'm charting top down, from the weekly, this is exactly where the majority of my levels are lining up, right? And here it's a wider range, but it's a wider range because of the values that that fib uses in its calculation to extend its levels. So it doesn't show me all of the levels that I would plot between this, but it's giving you a ranges within certain percentage points, right? And if you take a look at the settings, you can go ahead and it'll tell you what percentage points it's showing you here, the proportion, right? So so you go from 0 to 23 to 38 to 50% to 61.8%. 61.8% is, let me see. Oh, it didn't highlight it. That's funny. I know that that TradingView lets you highlight them by the level, the 68%. That one is like it's the golden fib, right? That's like the midway point of it. But I bring that up because this gives you at least a breakdown of the ranges that you can look at based off of a mathematical breakdown of where these ranges should fall or where they've fallen. So I go from February, or I don't know what I'm saying, from March 2020 all the way up to the current high to get the breakdown of the it's true, and I say true because it's the ranges that have been established since the last like big detrimental scare that we've had, right? So this is really solid start point to go off of. If we're then taking a look or more interested in the current range, right, or the current trend, because that is a 5-year trend. But if you want to take a look at what we've been doing since, because we ran up, hit high, consolidated, dropped, consolidated, and then ran back up again, and we're consolidating now. This is the last time that we dropped and reset a trend. So you can go ahead and actually do the same thing we did from March 2020 up to the current high, and you can look at these specifically, right? As far as where, if you're thinking we've reached all-time high, then these are the closer retracement levels that you want to take a look at. And I say that because what if I were to actually do my fib retracement from here to here. Why did it go that way, right? Because I'm telling it that the current trend has already been in retracement, right? Rather than the initial extension point from over here. I'm telling it that we're potentially looking at an extension because I started my point from here. So I bring that up because if you're charting from Webull specifically, it will give you different data points based off of where you're saying the current trend is starting from, right? When I start from a trend that's going up, it's showing me the retracement. And then when I start it from a trend that is going down, it'll give me slightly different levels. But if you wanted to get like a specific extension, right? In a if you're in a current trend or you think that this trend is still going, and actually let me use the bigger trend that we had started with, right? We say, well, this is where the trend started. We hit all-time high there, and then we had the drop there. Now it's showing you, it's projecting the what it could extend out to, right? So statistically speaking, these are the different deviations where if we're looking to break all-time highs, you could say we can extend up to all of these different levels, and these are all the different percentage levels. Right off the top of my head, I can't remember what's what, but it should go. Okay, it should be the same. It should go. This is the zero. This is the we're reaching a 23.6% extension, and then this should be 38. That should be 50. That should be the 61. So it just goes in order. But I wanted to bring that up because, again, it gives you a solid start. So the main thing that you have to determine on your end is whether you're looking for extension levels or whether you're looking for retracement levels. And you can use both of them, right, to identify the potential supports to the downside and then the potential resistances to the upside if you're trading at all-time highs. Do you all have any questions about Fib? Cool. So I
I don't,
definitely
but
have, uh-huh.
I have a really good book that I've read that taught me a good bit about it. So I'll put that in the chat as well if anyone wants to like really good resource.
Awesome. Yeah, and these are all things. It's definitely. I think it's going to be very, very useful, and these are things that I'm going to really emphasize and go into pretty heavily when when we start to take a look at the indicator side of things and how all of these are put together, right? Because so far I've just given you like little snippets or little nuggets of how I go about doing things. And I think I've tried to be um, pretty intentful in the way that I've done that because I don't want to like stress out or confuse people a little like too much. And that's why I hadn't really brought up Fib. Awesome. I've read some of that book. It's a good one. I haven't read it completely though. And I think it just makes it a little bit more digestible if we're able to go step by step. But I felt like this was probably a good time to start introducing this to have you all just start to play around with it and see how it helps you structure things initially. And like Mitch said, over time, when you start charting your levels first and then you use this, you'll see that they'll line up very, very closely. If not, they're going to be right on the dot as far as where they fall. Because again, all you're looking at or all the candlesticks are data points. And all you're doing when you're finding these roofs and tops is you're identifying the ranges of those data points. and fib is just all it's doing is calculating the percentages as far as like retracement percentages and extension percentages. So it's all just a math calculation.
And I do want to add to that a
Yeah.
lot of the reason why it works is because everybody else uses it and
One.
agrees that it works.
Oh yeah, that definitely, and that's in large part a huge thing that moves the markets as a whole, right? We've talked about this extensively as far as the fact that the fact that there are psychological levels, like we talked about the $50 price point right here on financials, and why is it been such a magnet, things along these lines. So we'll see trends and certain things play out time over time because of that psychological side of things. It's a great point to bring up. Let's go ahead and bring it back to the slides here. Moving on, communication. It's gained momentum, but stayed it's stayed pretty flat, right? If you take a look at the year to date progression, it's hit 0.1% year to date. And the biggest reason that it has seen this sort of stability is the fact that it is largely weighted by some of the tech names. Yes, you have other names that have been doing good for themselves within this specific sector. If we're taking a look at comms specifically, you have names like beyond Google, Alphabet, Meta, Netflix, things like that. The big or the heavyweights here are AT&T, T-Mobile, Verizon. You could include Disney in there, like Paramount, some of the streaming services. But the main ones that you're looking at are T for AT&T, T-Muse for T-Mobile, VZ for Verizon, CMCSA for Comcast, right? Broadcast company. You could take into consideration things like Foss Corp, Take Two, things along those lines, but not so much those. It's more so like the cell carriers, in addition to the bigger tech companies. And you've seen the cell carriers do rather well. It is what they're doing right now. If you take a look at the charts, for instance, let me bring this up before we even dive into the com chart itself. I'll go ahead and give you a look at why we've seen the sort of stability and not necessarily growth. But if we take a look at, for instance, AT&T, and let me actually delete the levels that I have here. What do you see just looking at this naked chart here? In relation to these levels here?
So much like consolidation, right? At those particular levels.
Yep, exactly. So if we take a look at this right here, what time period is this?
I can't see, but if I were to guess, that's definitely COVID.
It's pre. Yeah, but you're right. So
Oh,
this
right,
is
right before, yeah, right before the dip.
yeah, so this is the dip right here. So this is all-time highs 2019. So this is 2019 when the market across the board was hitting all-time highs, and this was the dip. And then it came back up to test those highs, and then it just kept dipping, right? It's been pretty bad. And then what did it do here? At around mid to late 2013, it's been on a run. And it's pretty much it's more than doubled price in the past. What is this now, like 2 years or a year and a half leading into 2 years. So all we're doing right now is retesting the all-time highs from 2019. So if we take a look at this across the board, and AT&T being one of, if not the biggest player, right? When you take a look at carriers specifically, then you start to build that understanding of why has it been flat, or why is it not as extended in relation to the tech sector specifically, or consumer discretionaries, or like all of these others. It's because we've seen this sort of consolidation, or didn't see the type of growth that these other sectors has seen in the past. So now taking a look at something like T-Muse, it's a little different, right? T-Mobile itself, it is at all-time highs. So then when you take a look at Verizon, oh, I forgot to just give me a sec. Cool. Let's find okay. This is what I was trying to find here. So if we take a look at Verizon, this one's a little bit interesting as well, because if we take a look at March 2019, look what happened here. That was the drop, right? Or here, actually. Need to get my dates. And let me expand the chart. There we go. The drop here, it wasn't as substantial as what the other drops were across the board. So it was a lot more stable, where at that floor, yeah, we dropped, but within the same year or so it came back up, right? And like the market, but across the board, it's been holding these levels relatively well. So if I extend that, right, we're looking
Say
at
the
that across the
drop
board.
in 22 is more substantial than that one.
Exactly. And all we're doing, very similar to AT&T, yeah, it's coming to all-time highs, but it's all-time highs that it's just been hovering at around. It hasn't overextended itself like you would have seen within Meta or Google or all of these other companies. So you are right that it's solid, its weakest drop, or its largest decline from 2021. This looks like it was October of 23 where it saw its largest decline before the run that it's now seen in the past, again, like a year and a half as well.
Right.
So
It
when
just
you
picked right back up.
Mhm. And it just snapped right back up to the neckline, right, that we see here. So I'm doing this, and I'm like really emphasizing looking into the reasoning why these things have moved the way that they have, because again, the idea is to identify the ones that could potentially have room for you to either trade to catch an options move on, or to potentially invest in. Because if I'm taking a look at calm as a whole, and I see, if I'm just looking between AT&T, T-Mobile, and Verizon, out of the three, which one would you feel most comfortable shorting, and which one would you feel more comfortable taking a long on? And not to say that it's going to play out that way, but for instance, if we're going to say, if we are going to anticipate, I'm sorry about that, or foreshadow a potential market drop, then I am interested in potentially, if I'm looking at communication sector as a whole, initially shorting T-Mobile, right? Because T-Mobile is the one that's been overextended in comparison to, or at least the growth that it's seen in comparison to these other companies. If we take a look at November 2019,
And it almost looks like a massive Head and Shoulders kind of in the middle of being formed.
yep, right from here to here, potentially we'll see price action reach or stabilize within here and then potentially drop down to the neckline here. So I would feel more comfortable saying if we are seeing a market-wide retracement, and I'm specifically looking to short any sort of communication name, it's going to be T-Mobile because T-Mobile has seen the largest growth out of AT&T and Verizon. Like those could drop with it, and they probably would drop with the market as a whole. But the move here isn't going to be as big as the move that you could catch in T-Mobile. And then on the opposite end, if the market's going to run as a whole, T-Mobile, the reason why it's grown as fast as it's grown in comparison to the other companies, it's that it's taken market share from them, right? When you take a look at, do you all mind me asking what carrier you all have?
Verizon.
Yeah, same.
Okay. Yeah. And you all are okay, and that makes a lot of sense to me. As far as like the areas that I kind of have an understanding of where you find yourself. Because you take a look at where are these companies like predominantly situated, or where do they have the majority of their cell towers and things like that. T-Mobile, out of the three that we've discussed, has expanded the most. So within the past 5 years, they've put out the most cell towers and grown their network the fastest in that way. And that's why they've been able to gain market share, specifically on the West Coast. And specifically within the like border the borders of it, whether it's like the Pacific Northwest or like the Southern California area, even like Arizona, stuff like that. They've grown pretty substantially, and they've also introduced internet or services right to their network. So that's been fairly interesting to see how that has increased customers acquisition, and they've also have stuck relatively true to their what's it called, to their no hidden fees contract and no what is it, no contract locks. I think that's what a lot of service or communication service providers call them. So when they show on their website like this is the price that you pay, that's the price that you should be paying. There's no like extra hidden like usage fees, tax fees, or anything like that. Their prices advertised are already including all of those things. In addition to that, these are all situated as month to month contracts. They don't lock you in for like a year or 2 years like a lot of service providers do, but they do. And that's what people don't realize. And I say this because now the model that a lot of these carriers have been shifting over to is, okay, we won't tell you that we're locking you in for 2 years. Like the contract won't say that, and legally the contract can't say that. But what they do is they lock you in with your phone payment plans, right? If you're not paying for your device outright, a lot of the companies will say, hey, actually, if you transfer over from another carrier, we're going to give you a completely free device. But that free device is given to you free over a 2 year time frame where they give you monthly credits. So if you were going to originally pay like $20 a month for 2 years for your new device, they cover that $20 per month, and that's how they lock you in, right? Because if you have that free device for a month and then decide, I actually don't like this service, I'm going to actually move back to my old carrier. Well, you're stuck with that device because that device is carrier locked. You can't move it back to Verizon or AT&T unless you pay off the device, right? So this is done because yes, you're not locking people into a contract, but if they choose to move, at least they owe you the price of the device that you had originally told them was for free, and you're actually still making some sort of money off of it. Right. So there's still ways that they've made their money. So if you take a look at, I just bring that up because if you take a look at the earnings report, it's very interesting how they break where those earnings are coming from. And yes, they've increased customer base or their overall subscription by a lot, but they're also making a lot of money with those breaks when people decide, actually, I don't longer want this service, but I'm still giving you money to pay off my device to then move to another carrier. So very interesting what's going on. But that's why I know that T-Mobile has seen that huge increase. It's become pretty stable, especially when you're taking a look at predominantly like underserved communities. If you're taking a look at like Hispanic, Latino immigrant populations, that's been a lot of their customer acquisition has came from those specific communities. So pretty interesting stuff. Let's go ahead and move over. Sweet. Want to bring up consumer staples, and I'm hoping to pick it up a little bit quicker. I know that we're getting a little extended here, but there's so much to go into these as when you start to analyze them in depth and really to build a whole understanding of it. You need to be able to or be willing to look into all of those things, right? Like we talked about the communication sector as a whole, but then what's actually moving it, what's holding it, which ones are the ones that are extended, which ones are undervalued currently. It does take a good amount of time to go through it. But today's intention was to give you a glimpse of that and hopefully to prompt you to be willing to do that on your end as well. Because on my end, yes, you're going to get like moving forward on a monthly to monthly basis, a literal in-depth breakdown of every single sector. I usually include like a paragraph or two of the reasoning or the interest behind that sector, what's driving it, what's pushing it down. But I don't want you to just take that at face value. This meeting today is to prepare you for instance for next month when June comes around and I give you that in-depth detailed breakdown of every single sector for then you to hopefully go back and then break down that sector yourself and analyze which companies are of interest within these sectors based off of that initial info, right? Because I never want you to take anything at just that face value and say, oh, this is the one to go into or this is the one to shift out of. So when we're taking a look at staples, traditionally it's considered a safe haven, especially in the midst of volatility. When you take a look at companies like your Pepsi, your UPS, your Coca-Cola or KO, these are often able to mitigate a lot of the challenges because of that vertical integration that we talked about in last week's meeting and the ability to manage or cut in certain areas that some companies don't have a say over because they might not own the supply chain to it. They might not own the transport to their products and things along those lines. So year to date, because consumer staples has seen about a 4% return. So relatively good return in this specific sector. When we take a look at the chart itself now, we are going to be able to see that just like the rest of the market, we are hovering at these pretty extended levels, right? And let me bring it down a little bit more here, and we'll go ahead and take a look at the fibs again for here. When we take a look at that retracement as a sector, very similar, like you see in almost every other spider S&P 500 sectors. You see that drop in that boom cycle after it. This is always to me considered a consolidation. Almost every chart between late 2021 to about mid-October 2023, you saw that consolidation. It was just trading in a range before we actually got the year and a half, almost 2 year breakout into like current trading time. So I bring this up because again, I'm taking a look at what are my supports, what are my resistances. This breaks it up very, very beautifully. The one that I'm always keeping in mind is this right here, the previous all-time high, because to me, a lot of this is it was artificially inflated, right? And then the most of the market is to an extent when you think about how the Fed moves things around, like we talked about last week with monetary versus fiscal policy. So I at some point thought we were probably going to come back and touch these levels, and yeah, we did here, but I thought around here in October, late 2023 that there was potential to come back down and retest these levels. There could be over time, but at this point in time, what we're looking at is a retest of the previous range before we broke out. And what would that previous range be? It's these highs right here, right? Rejection, rejection, rejection. So 1, 2, 3, 4, 5. You can even count this one as a sixth rejection before it broke here, created the base. So this is the lower range, and then this is the higher range that we're currently trading in. Of course, this range we can then break down to give us more refined levels on the weekly. So we go ahead and give ourselves that level there. We go ahead and give ourselves that level there, knowing that this is a very strong, it's going to be pretty wide when we take a look at this. It's about a $5 zone here on the weekly, but it's a very strong zone because it is a weekly. So we're looking at potential either break to the upside to create new all-time highs, or we're going to go ahead and retrace. And if we do retrace market wide, if we see the market feel like we're overheating, we're going to potentially see some detriment, then this is probably going to hold here, right? Because it's where we find that safe haven or where people feel comfortable. So if that happens, we're either going to break or we're just going to consolidate between about 79 to 83 range within consumer staples specifically. So as you see consumer staples inch or reach towards its all-time high, that could be then, if again you're taking all of this into consideration, if you're digesting all of this information, look at the relative rotation graph, look at these rotation indicators and see is it moving from, and let me bring that up again actually, so we can take a look at where it was currently. So if we're taking a look at XLP specifically, let's go ahead and I'll bring it up to you right now. I'm just fixing the chart up right now. All right, if we're taking a look at it specifically, here, XLP, it's been hovering from leading to weakening to lagging potentially. So it could go into lagging. And would anybody be comfortable or willing to tell me why it could be currently going from weakening to lagging? And it's a point that we already touched on very early, and it has to do with one of the other sectors that we talked about.
Yeah, for all the stable, like just food in general, and um, all the prices of, yeah, just everything that we use going up.
Yeah, that has a role in it. And remember, in relation to consumer staples, if we're seeing something like this happen with tech, where it's leading, remember that relationship that they have with like the growth stocks in comparison to consumer staples. They oftentimes have an inverse relationship. So a lot of the time when you see tech, when you see even the financials, when you see energy, when you see specifically the two that I would love for you all to keep in mind is when you see tech and when you see consumer discretionary specifically. So XLY, and let me take energy out, right? When you see XLY and XLK in a improving or leading phase, check to see where consumer staples is, because a lot of the time it might be in a weakening and lagging, right? Because at that time is when the market starts to feel a lot more comfortable saying, hey, we're probably going to get a push up. So I want to catch the move in those growth stocks. And remember, tech and consumer discretionary are things that the individual doesn't really need, right? It's not a necessity to live, where consumer staples are considered more of your day-to-day things when you're thinking about like Procter and Gamble, buying your toothpaste, your toothbrushes, your deodorant, your shampoo, when you're thinking about, right, like Estee Lauderdale, when you're thinking about or is that what it's called? I forget. Or when you're thinking about all of these different companies that appear in your day-to-day life, even just your drinks, right? Your water. A lot of the times people think, or where people might get mixed up is, well, why would Coca-Cola be considered a staple if they sell soda, and soda isn't something that the day-to-day individual needs to live? Right, that's a big question that I ask myself. And for one, well, a lot of the people, the majority of society, you're hooked on sugar, right? So it's always the sugary drinks that sell the most. But even taking that out of consideration, they don't they own different brands, right? So what's a water brand that Coke owns?
Dasani, right?
Yep. Yeah. So they're not just making their money from the soda, right? That's what we all think initially. Same thing with Pepsi. It's not it doesn't just own the the Pepsi soda line, right? They own a lot of different different companies. And funny enough though, both of these are actually partly owned by an even bigger conglomerate. Right, but we won't
Oh
go
yeah.
into too much detail
Fun
on
fact
that.
though,
Yeah,
Pepsi used to have the seventh largest navy after buying some ships and stuff like that from Germans.
that is
So at
insane.
one point, Pepsi had a navy.
That is so crazy. And that's those are all things, right, that we don't take into consideration, or that we don't see like at face value. And then like you have to really dive into what is actually the wealth behind the company itself. But I think that currently, being that you see XLK and XLY in an improving leading, they're in leading specifically right now, is because there's that optimism that the market's going to keep running. So naturally, people are more willing to move the money out of the traditionally stable sector into these growth or riskier sectors. But as soon as you start seeing those earning reports in tech drop and drop, and as soon as you start seeing those consumer discretionary, so the brands, the luxury goods, as soon as you start seeing them report lower earnings or even losses, you're going to see staples go quickly from weakening to lagging to improving. Right. So those are the cycles that you want to keep in mind as we move forward here. Let me erase these. real quick. Let's go ahead and move over to consumer discretionary. Which are some of the big brands that you all know or that you all tend to purchase within the discretionary ETF? Let's go to consumer discretionary.
Uh, I mean, definitely have some Nikes.
Yeah.
I mean, everyone uses Amazon.
Oh yeah. Let me bring.
Home Depot too, probably. I'm not a Starbucks drinker though, so I can't say that one.
That's good.
And I don't eat McDonald's anymore. So
Oh no, I don't want to create an order. I'm about to buy some shares. Awesome. Oh, that's really good, actually.
yeah, it's been over a decade now since I've put any of that in there.
That's awesome. It's been a while. Like we do our best, and sometimes we fall short, but
But if you're on the road or something, like, yeah, I can't help it. But
it's different. Yeah. Okay, sweet. Okay. Yeah, I was looking at all the names that I have. So what I do, well, where did it go for me? Oh, did I lose it? There we go. So typically what I do, what you're seeing here, I literally I have a watch list where I have every sector, and then all of the holdings within that sector. So we have XLY here, consumer discretionary, just like every other sector, right? We're pushing up towards those highs, but we're not there just yet. So before I show you my chart, just want to show you this very quickly. Year to date, it's down 9%, a little bit over, but basically not 9% year to date. A lot of the mixed performance in this has to do with Amazon and the Amazon being like the big shipper or the big online e-commerce company or brand, right? That being one of the large indicators as far as how many things are being sold and bought online. What do those transactions look like? The fact that it's feeling some sort of stressors, specifically related to tariffs when you think about luxury brands and the big push that is happening. Have you all heard about the big, I don't know how to say this without telling you right away, but there's been a big push, at least in the past like month or so, to move away from luxury brands. And do you all understand the impact that luxury brands have had, especially when you start thinking about like fast fashion and the some people would even look at it as like the colonization through the fashion industry.
oh yeah, they got hit pretty hard with because they just what all the Chinese companies just started to release that like yeah, all our material, everything's pretty much the same except the name.
Exactly, right. Because they're it's all being produced there. So they're that definitely opened up a lot of eyes as far as like like yes, it feels, it looks, it is quality, but how is it being produced, right? And how is value derived from that when you realize that this bag or this shirt, this sweater is being mass produced, and the actual cost to produce it is a couple dollars in comparison to a couple hundred, a couple thousand that it's being sold at, right? And one of the biggest and like interesting things that I've heard in the past month or so specifically related to consumer discretionaries has been Mexico's president. Their push to kind of, well, not to kind of, but the hope to bring back more interest in locally produced and manufactured goods. Because when you take a look at again, if you're taking a look at this more on the like colonization side of things, or the cultural appropriation and things like that, where where certain brands, sorry, oh, I'm starting to lose my voice. When certain brands have taken designs, have taken things that traditionally show up within certain areas of the world, within certain cultures, and use those designs to profit from, it really hurts those locally, right? When you're thinking about people that are producing things and by hand, and the hours that go into that, and the inability to actually to actually produce something at the price point that somebody would be willing to pay for it. Have you all heard of indie techs?
I have not.
I
Okay.
haven't.
Yeah, the majority of people have not, and the reason why you haven't is because they don't want you to know of them, right? So if you take
What
a
is it
look
called
at
again?
indie techs, so it's a textile company. So this company, if you look it up, and I don't think I linked it to here, but I definitely want you all to take a look at it when it comes to fast fashion and just the consumer discretionary sector as a whole, and what's happening abroad. So in Inditex, it's a textile company that was started back in like in 1985, if I'm not mistaken. It was started in Spain. It was started by this guy whose father worked in he worked in the industry, but this company started first as a textile company. So all they did was produce the raw material, right? That's what they did for years. But over time, they expanded, and their actual, like, one of their first brands was Zara. That's very popular today, right? As far as like being able to mass produce certain clothing, and the way that they've changed like the brick and mortar shopping experience. So that's one of their biggest brands that they own, but they own a few European brands, being that it is a Spanish, it's a Spanish conglomerate, so it owns companies like Massimo, Bershka, what's the other one? Oysho, things along those lines. So when you take a look at a company like that, what has really hurt the industry as a whole is its ability to grab onto designs or trends, things that they see building, and have them in turn in the like in their brick and mortar shops within I think it's like a week's time. So they can see something like go popular online, whatever, whether it's like a viral post video, and then say, oh, like we really love that design, and then have it on their shelves within a week's time. And the reason they can do this is because they have, man, I really missed out on this opportunity, but I'm going to follow up with like all of this info and where to look at this research. But they have a specific system set up where it's like real time data. And they were one of the first organizations or companies, conglomerate, to establish this sort of system where real time, when they pull up their management system, it will tell them this is the rate that these products are being sold not only throughout the entire company, to throughout the entire brands, but within a specific location. So they can see this specific shirt, this specific product, whatever it might be, is selling really well at this store. Let's go ahead and triple the shipment that's going out tomorrow to them about for this specific item. Or it's not selling at all. So let's cut it. Don't send any more of that there. But the store in Brazil, that one's really selling a lot of it, right? So they're able to see this real time, and that's how they've been able to position themselves in order to exploit, right? It is exploitation, the way that they manage their business, and nobody's ever going to say that. And at the end of the day, they're not worried about what's happening to the mom and pop shop or the individual that's producing their goods by hand. They're just worried about margins, right? And the overall sales net profit that they're making. And they have that sort of system. So I bring this up because that's something that a government like Mexico, right? And I bring up Mexico specifically because Inditex has seen its largest growth within Latin America. So when you take a look at in North America, specifically like Mexico, right? But then when you're taking a look at Latin America, places like Peru, Brazil especially is very troublesome because a lot of the fashion, like a lot of the fast fashion goes there last. And it's like you know how when things don't sell out, you'll then find them at discount stores like your Ross, your TJ Maxx, things along these lines where you get them at a pretty heavily discounted price. What happens is that then everything that's not like that you just can't get rid of, it then finds itself in these Latin American countries, places like Brazil, where they offer the opportunity, and we're starting to see this here as well, but they have already been doing this for decades, where they offer the opportunity for the individual to buy these things on layaway. So you can literally buy a shirt in like a year installment plan, right? The 12-month payment plan. So a lot of these individuals that traditionally, when you're taking a look at things like wage disparity and that traditionally they can't afford a lot of these things, that they actually go into more debt to be able to have that feeling of like, oh, I'm getting something new, right? I'm able to have these brands that I see being posted online and things along those lines. So I bring this all full circle back to my comment about the Mexico's president now pushing against those traditional brands or like luxury goods and saying that they're going to start to look for ways to subsidize the growth or the systems that are available to the individual producer, to the especially when you're taking a look at like their indigenous populations in those areas that don't traditionally have access to or even an interest in setting up a business online or having these systems set up. So how do you support that individual in selling the baskets that they weave themselves, right? The traditional the traditional clothing that they produce, how do you support them and the potential to then grow out their own brands from that, right? How do you prop up an artist and saying, hey, why would you want to go be a designer for a traditionally known fashion house like Versace, Prada, whatever it might be? Why don't we help you establish your own brand, right? So I think currently they're working with one brand directly that they're trying to say, hey, let's see this type of experiment out. Let's grow out this brand. Any sort of designers from Mexico specifically, why don't we offer them this opportunity instead of having them go abroad and use their expertise elsewhere? These indigenous individuals, like, why don't we help all of this become its own system within our country. So that to me is very interesting to see how that might affect the overall discretionary sector and where goods are being produced and where goods are being bought. So that's my whole spiel about the consumer discretionary sector so far. If we're taking a look at the technical side of things, of course, if I'm not mistaken, I should be sharing. Yeah, you all see my chart here. So when we're taking a look at the chart itself, I am eyeing these tops, right? Specifically this region about the 214 level, the 226 level, and then the 239 level. Those are all upside levels that will easily touch if the market as a whole starts to stabilize here. Again, if we have a stable market, there's more willingness to go into riskier investments, into things that we don't need, into luxury goods. So this could potentially, if tech pops, if the market sustains, this is going to pop with it. But if it doesn't, I think that we could potentially, like we've seen in other charts, play out a potential head and shoulder pattern here, right? Where we fall back into this range that we saw from what is this, March? Okay, cool. Like 2023 to about mid 2024, late 2024. So about a whole year consolidation here. We could come back into it and trade here, or even if worst case scenario, start touching these lows. But what's of interest to me is if we retrace, one of the very first ones that will end up retesting the 2019 high is consumer discretionary, right? It's the one, if I'm not mistaken, it's the one sector that did. If you take a look at this time frame here, it actually did retest and it broke below the previous all-time high before we got that retracement. So things to keep in mind as far as where it could go, current market sentiment, things that are going on within that sector, specifically both within our country and outside of the country, because it is consumer discretionary. It's e-commerce now, right? So it is not only things happening within here and how it affects us. You really have to take a look at the global side of things. Any other questions or any questions about consumer discretionary?
Oh, sounds good to me.
Sweet. We'll go ahead and dive into energy. These are the last few the last few sectors that we'll go over. If I'm not mistaken, we just have the energy sector to go over. We have industrials. We have materials, utilities, like healthcare. So there's a few more. We're about like halfway, but we won't go super in depth into all of these. I don't feel a need to because of where we're currently sitting. For instance, energy, we're facing pressure from weak oil prices and increased output by OPEC. Why would an increased output in oil lead to pressure or weaker oil prices? It's supply and demand. So the more there is of something, the less it will cost, right? The more availability, the less of value it has. So this is something that I wanted to bring up specifically without even looking at the chart itself is you see these fluctuating prices in large part due to what OPEC does. And if we don't know what OPEC is, I definitely encourage you to take the time to look into it. It's the organization that oversees the oil production side of things, right? So they oversee how much oil is being put out there, how much of it is being pumped out of the ground, at what rate it's happening. So there will be times where production isn't all there, or we're not releasing as much oil to the market on a month to month, quarter to quarter basis, whatever it might be. So there's always an OPEC meeting that you might want to keep an eye on as far as the numbers that they release, because like I said, right now we're seeing a decrease in oil prices, and it's weakening because there's more of it out there. And you could say that this is being done intentfully in order to mitigate things like the rising tariffs, the fact that the current administration has made it very clear that they want more production coming out of the US, so not necessarily heavily rely on the Middle East for that majority of the production. So what do you do when one of the biggest customers is saying, "Hey, we want to produce our own," then you flood it, right? To make sure that the price or the opportunity for US production or profit isn't as much as it could be. So different ways to attack that. When we take a look at the industrials themselves, it's been leading in current gains as far as, for instance, the past week, we saw about a little bit under 4.5% increase, and this is driven by the strong earnings within the sector. If you take a look at industrials specifically, some of the more popular names are going to be your HON, so Honeywell, UPS, RTX, right? If you're taking a look at Raytheon, Triple M, Boeing, Cat is on there. What's the other one? DE. If you're taking a look at things more like in the aerospace stuff, you can take a look at GE as well. If you're taking a look at the defensive side of things, in addition to RTX, you have Lockheed Martin, so LM&T. FedEx is in there, as well as UPS. You have WM
Got
Waste.
deer.
Yeah. So you have all of these big companies that are on the more on the like production side of things. So when you think about building out a country, when you think about defending a country, when you're thinking about all of those like on a higher level, like who's going to build your roads out, who's going to take care of your farmlands, who's going to defend your country, things like these. That's what you're referring to when you think about industrials. So as we are facing current tensions, a lot of these start to receive more interest. If you think about, it's not necessarily found within industrials, but it wouldn't surprise me if at some point in time, do you all know which has been before I let you know, do you all know, or can you think of which has been the fastest growing potential defensive name, or when you think about a company that has received a large amount of government contracts in the past like year or so, what has been one of the biggest winners and has had like a ridiculous run?
Uh, is it Raytheon or
It's within those. It's not Raytheon specifically or Lockheed Martin.
I know I'm like blanking on the on the name of
You
it.
know it. I know you know it. And it blends between like industrial and tech side of things. And it's more heavily now on the AI powered side of things, and the work that they do. More like
Is it Palantir?
it is Palantir,
Oh,
100%.
yes, yes,
Yeah.
yep.
So Palantir isn't necessarily, it's not found within the industrials, or it's not really like categorized within the defensives, but it's going to be there at some point, right? So I bring this up because as you've seen this sector as a whole, like increase over the past 5 years, and the emphasis, and we need to prepare ourselves as a country. The in historically, in the past decades, we've traditionally seen the defensive and the industrial side of things as the physical, what we can see, right? So the roads being built, the tanks being produced, the weapons being produced, and things like these. But whereas Palantir differs, it's not so much focused on building out the tanks and building out these weapons. It's on the systems behind those, right? So it is a systems based company. So it's a software developer. So when you think about how has war changed, or how is it changing, a lot of it, and a lot of people say we're currently in a silent war, right? Because you don't see people as much, at least like the US and like China and Russia, not necessarily like fighting each other on the battleground, or like nuking each other, things like that. But a lot of it is happening on the cyber side of things, right? Well, when you think about cybersecurity and different government agencies being hacked, or data being taken from certain organizations, things along those lines. So Palantir is definitely heavily invested in that side of things. So when we think about how is this potential sector shifting, and defense specifically, this is going to be potentially, I say it's going to be a big player long term. And just look at the stock price. Well, where is it sitting now if
Yeah,
we
it's
want
crazy.
to?
It's just under all-time highs.
Right. And do
Just barely.
and take a look at, and actually I'll bring it up because to me it's I laugh because I held this at some point, and I'm just like, I feel like it's
Same.
one of my like dumbest moves. Look at the low it hit, $5.84.
Yeah.
And that was literally what was this like, um 2 years ago, right? So
Barely,
everybody
yeah.
thought like it died from the hype of 21, and then it just ran down. And then all it was doing here, it's very interesting. I haven't completed like my whole in-depth look into this, but if you take a look at the moves they were making and the research being done between 2022 and like late 2023, it was really the reason why it was an accumulation phase here of consolidation was that it was reworking a lot of the way that the company was structured. And throughout this time, what it was doing, it was accumulating government contracts. And now the spike that you see here is now the execution of those contracts. And now the market's seeing like, oh, they've been able to hit on a lot of things that they've been contracted to do, right? So it has been the company that has grown the most with government contracts. And just when you think about the why are industrials so heavily emphasized when you see any sort of retracement or uncertainty in the market, is because when you take a look at companies, specifically companies that predominantly rely on government contracts, those companies are never going to fail unless the government fails. Because they're literally backed by the government. That's where their money comes from. So the only way that Palantir at this point in time is going to go to zero is if the government literally just disappears. If the government crashes, then that's when companies like Palantir, Raytheon, Lockheed Martin, that Boeing, even at that, right? Why has Boeing stayed at the levels it stayed when they've had numerous plane crashes, when they've had numerous incidents, right? It's because they're a government-backed company. So that money, to an extent, is never going to stop. They might cut some contracts here and there, like they have, but at some point, they still have the ability to gain more government contracts and gain more money from them.
Aren't there earnings tomorrow?
For Boeing, I think so. Is
And
it?
for PLTR,
Or actually, no, for Boeing, it's not. Boeing, I
right?
think we already passed. For Palantir, uh, I haven't checked. Let's take a
Usually
look at the
on
news.
aftermarket on Cinco de Mayo.
Oh, yeah. So that'll be very interesting to see how that plays out. I mean, they
And they're
beat
right at that level.
substantially. Yeah, they're right at the all-time high, and they beat substantially every single quarter for the past year. So just quarter over quarter, you go from a 4% beat to a 10.5 to a 10% to a 23% beat. And this is all from that increase in government funding, right? So the amount of money that goes into developing their software and their foundation is substantially less than the amount of money being awarded to them. So that's where you see that huge increase in EPS and revenue quarter over quarter. It's a great one to keep in mind for sure. Let's go ahead and right now, do you all you're just seeing my industrials slide, right?
Yeah.
Okay, cool. Awesome. So let's go ahead and look at materials. Materials, the reason why this is pretty interesting to me is the fact that this is the raw side of things. So this is one of those sectors where very similarly to the industrials, they see that interest and utilities as well. These see that interest gain or being emphasized once we start to see some sort of scare or like greed overbought markets start to play out. So modest gains so far, but the concerns over the global demand and in trade, it does play a role in this because it's literally the raw materials. So it's those that produce, for instance, if you're taking a look at Sherwin-Williams, when you're taking a look at overall chemical production and paints and things like that at the industrial level. If you're thinking about Ecolab, if you're thinking about Dow, DOW, Ball, AV, FMC, Tech, WRQ, PKG, like all of these companies are probably companies that you don't relatively see Rio Tinto. X is probably the one that everyone might know, which is US Steel, right? So all of these companies that I mentioned, they all produce some sort of raw material. CLF, Cleveland Sands, or it's Cleveland Cliffs. It produces a lot of like raw earth materials. So different companies doing different things, but these really don't move for the most part, unless you're seeing big shifts. So if we take a look at my chart here for materials specifically, like every other sector, it saw that drop in 2020. But what have we done here? Let's take a look at the fib retracement, right? If we go from there to all-time highs, yes, we ran up with the rest of the market, but what happened from 2021 all the way to 2024, right? So it was essentially a 3-year run where it was just consolidation. And at this point, it was consolidation because, yes, we reached a high around like 2020 in the market as a whole, but then we saw a pretty steep decrease for a year up to October 2023, when we saw the market run up again, right? So you see that move happen here, but it's a less dramatic move, right? The shifts aren't as heavy, whether it's a run up to the upside or a retracement. They don't happen as fast or as in large increments as the tech sector would. So yeah, we're still within this upper range, but just well, what is this just a month ago, right? When we take a look at the relative rotation graph, just a month ago, we're actually trading back within that 3-year consolidation range that we had. So this will always act as a magnet depending on what we're currently experiencing. Definitely things to keep in mind. I don't have a whole lot to say about materials as a whole, other than it's what the raw primo material, right? That is available to all of the other sectors. Because in one way or another, all of the other sectors they pull raw materials. Whether you're thinking about the car companies, especially those that are transitioning to producing more electric vehicles, when you're thinking about the extraction of cobalt and all of these materials that play a role in the battery production side of things, those are the things to keep in mind, but not so much. Not so much to talk about other than keep an eye out on what other sectors are moving in certain ways and what materials do those sectors use or are in need of, because those are going to be the plays that you're going to get to benefit from when it comes to materials, is when you build an understanding of if Apple intends to double their production of the iPhone, well, they need batteries, they need X, Y, and Z. So which are the material companies that they use for those, right? Because Apple doesn't produce their own cell phone batteries. Apple doesn't produce their own adhesive for their phones. They don't produce the gold that's used within their chips. They don't produce the specific metals that are used within their devices, right? They bring all of these materials together and then they put their phones together. So what companies are supplying them with the raw materials needed to produce their own goods? That's what you want to keep in mind. Let's go ahead and keep pushing here. When we take a look at the utilities as a whole, these have within the past week, it's been under a little bit under a 1% gain, but year to date, they've seen about a 4.5% gain. So this has been very similar again to industrials, to the defensive side of things, to the material side of things. It's held up relatively well because it's been a place where people can shield their money. When you take a look at utilities specifically, there is also a blend between the energy side of things, right? Because what are the biggest utilities that we make use of in your day to day?
Uh, Electric, Wi-Fi,
Yeah, for sure. Electric, your oil, right? Your gas, your
natural
water.
gas.
Mhm. So those are
Basically
probably
Duke Energy.
exactly. Yeah, I mean, if you take a look at the sector breakdown here, Duke is definitely a big one here. You have Nextra Energy. You have AEP, which is American Energy. So there's lots of different ones to go through here as far as those that produce some sort of utility for us. WM also balances between here, so the waste management when you're taking a look at those, but in particular, there's some sort of energy, water, things along those lines. So taking a look at utilities themselves, this one very similar to the previous sector that we were looking at, right? It had its retracement and it's popped to all-time highs, but it's definitely not as big of a move as those. And again, it's because there isn't a lot of money being made in these companies and these sectors in comparison to the tech and the growth that you see there. And the reason why is that very similar to the material side of things, there's only so much raw material that you can extract, right? And there's only so much that you can do with these certain types of companies. Me Extra, Duke, they're never going to be producing their own software, right? They're not going to do that type of thing where software can be expansive and it can go into every single industry, right? Because these companies themselves, utility companies, they use software that are being produced by tech. So it's never going to be a sector where it's being used across the board. Yes, you're being used across the nation, across countries, but it doesn't operate when you think about like net revenue and the way that you produce gains within this specific sector. It's not positioned like a growth sector would be. So that's why you don't see that that expansive move or large retracement, because to an extent it's always going to be stable. And yeah, it's nearing all-time highs here, and it could break, but it's not going to be a $10 move to the upside, right? Like it could be in one day in the tech sector. We go ahead and move on to healthcare. The last couple here, when we think about healthcare, when we think about real estate, those are the last two that I want to go over before we wrap up, and really the last two of the 11 here. So I want to thank you for sticking by so far, because it's a lot to cover in these quarterly sector breakdowns, and monthly sector breakdowns are always going to be the more extensive conversations that we have, as far as wanting to break down or give more insight, as much as in-depth understanding as we can bring together. Healthcare has been pretty steady. And the biggest reason why you see it break even year to date, or just being steady in the past week and month, has been the fact that a lot of these producers, a lot of the big players within healthcare, they don't necessarily or aren't impacted by the tariffs and importing a lot of these things, because a lot of these organizations, companies, that they produce their things in-house, right? It's the pharmaceuticals, it's the Johnson and Johnsons, it's the Pfizer, where all of those are being produced here. All of the vaccines, all of the medical devices predominantly are being actually put together. And I say put together because these components might be coming from outside, but they're being produced, put together here in large part. And then you think about one of the biggest heavyweights, right? When you think about UNH, they're not necessarily a pharmaceutical or a device manufacturer, but they're an insurer, right, within the healthcare industry. So that's also part of XLV, the healthcare sector itself. So when you think about these things, I want you all to be able to split them up into the niche categories when you're taking a look at the pharmaceuticals, or the actual producers of medicine. So when you think about Thermo Fisher, when you think about MRK, so Merck, when you think about LLY, Eli Lilly, when you think about Pfizer, or when you think about Moderna, right? Those are different than your UNH. It's different than your Johnson and Johnson. It's different from your, I'm forgetting the other medical device producer, forgive me. But even beyond that, when you're taking a look specifically at biomed, or pharmaceuticals, Abivine, these are all within their separate areas, but they do make up the healthcare, and they all balance each other out. So when you might see a large run in the pharmaceuticals, which tend to be very volatile, right? Pharmaceuticals typically only run when you see a pretty good production or a pretty good outcome when it comes to medical trials. That's in large part due to that. When you're taking a look at medical trials specifically, the pharmaceuticals, they're largely dependent, is the term that I was looking for, largely dependent on the trial data, as they should be, right? You don't want these pharmaceuticals going out if they're not actually helping the individual to an extent. And that's a larger conversation too, as far as how the pharmaceutical industry works and the evils behind that. But we won't go too in depth into that. When we take a look at where it's currently standing and the reason why I felt comfortable selling out of MRK or Merck was because of what I'm seeing here. We were balancing at around all-time highs when I was holding it and sold out. It was around here. I bought in initially in this around this bounce. It wasn't the complete bottom of it, but it was as it started to loop back up and caught some initial momentum there from the end of 2024 and really didn't hold it all that long because I instantly saw the opportunity to gain a little bit more if I was willing um, to at least hold up to here the neckline of this move, right? Because in my mind, like you all, I'm seeing the same thing, a potential head and shoulder pattern there. So that's what I was initially seeing. Got the opportunity to come back up to the neckline, take some profit, figure out where do I reposition myself, and one of the biggest things or reasons why I took the time to do the sector breakdown is that I do want to figure out, is it time to buy back in everything that I sold out, or what other companies are bringing in opportunity. So having this bounce here now in the next week or two, I want to see, are we holding this neckline, and are we going to come back up here, break, retest, and then try to go for all-time highs? Or are we going to reject, fail to hold at these levels and potentially test and then make our staircase down, right? Those are the big things that I'm keeping in mind when it comes to healthcare. I am still working through figuring out what am I mostly interested in, whether it's companies like J&J. This was part of our charting session about 2 weeks ago. Why am I interested in potentially investing in this is because, yes, we're at all-time highs here, but we're at the midway point of this range that it's been trading in since 4 years ago, right? Since 2021, we've been trading within this range, but currently we find ourselves midway between that range. So are we potentially looking to take a next step up, or are we just going to retrace here like we did in this instance, in this instance, in this instance, right? It seems like every other time we make a move, we reject, except this time we rejected twice, right? So ran up, rejected, ran up, broke, came back down, broke, came back down, rejected, broke, rejected, broke, it broke. So now is this a double top like it was here, and then we come back down? Or do we bounce, right? We did come back down here and we're bouncing. So I'm just waiting to see what happens at this midway point. So J&J is very interesting to me. I have my own thoughts on UNH and really wanting this to go as low as possible. I don't think I'll ever invest my own money in it. Pfizer has been killed for a long time now. It hit that high of 53 back in 2021. But I'm interested in this consolidation that it had and how this is potentially a neckline, right? So if we had that potential head and shoulders, are we going down lower? Are we going to test levels? Because right now, to take a look at where we're at, we bounced off of the lows from 2026. So whereas it's next year, we're a decade from that initial low and bounce. So are we potentially going to just follow the staircase down, right? Follow the 26 low, then aim for the 25 low, then may aim for the 20, I said 25, I mean 2015, then aim for the 2014 low, and then aim for this 2013 low, and so on, right? Like, are we just going to follow this staircase down this way? Or is this going to be a potential bounce to then follow the staircase back up and potentially aim for this range between it was the range before we got that COVID drop. So are we going back up to the COVID highs is what I'm wondering. And what does it take to get us there? Because keeping in mind, in order for this and players like Moderna to get up there, it literally they were driven by COVID vaccines and nothing else than that. There are other pharmaceuticals that were being produced. They were to no level near the production of that specific vaccine. So what would it take for them to go back up? Is it even reasonable to say that they would? The only one that that can do that without necessarily needing any sort of like COVID vaccine boost or any sort of big sickness like that, because it already is entrenched in a big sickness, is MRK, Merck, because they are the top producer of cancer-related drugs. So that's why it's relatively stable. I mean, it's seen a huge drop off, but that's why it has that potential and it always will have the potential for growth because it's been one of those sicknesses that the healthcare industry, in all honesty, is in no quick rush to solve. Right? Because if you take a look at all of the medication, it's all to mitigate, or it's all to what's the term for it? It's not preventative or it's not to like resolve the issue. It really is to just oh man, I'm blanking out on the specific term, but it's essentially to mitigate, right?
I know, I
Or
can't
to
think of it either.
there's a term though. I
It's
know you
basically
know
to maintain it.
right. Yeah, that's what it is. But there's like a specific medical term for it, and I just I'm at a loss for words right
Perpetuate
now.
it?
Not perpetual. I mean that is what they're doing to an extent, but I know there's a specific medical term, but it is just to maintain or to mitigate, right? To try to extend life, but not necessarily to cure. That hasn't necessarily been the intent. So this company is always going to make money hands over fist because of that specifically. So now taking a look at our last sector here, and then to wrap up the conversation today, we're taking a look at real estate. So XLRE, it is up about 4% year to date. It is benefiting from a shift towards defensive stocks towards the industrials because this, when we're thinking about money flow, not necessarily within the market, right? We've touched on this in previous meetings and conversations where money flows from the stock market to the real estate market, to commodities, to crypto, right? There's other financial markets out there where money flows in and out of. So when money is flowing out of the stock market specifically, a lot of it tends to find itself in the real estate market where you see something physical, you have land, you have a physical structure, a building that can hold some sort of value and mitigate some sort of depressionary period or some sort of recessionary period to an extent, right? In comparison to the loss that stock would potentially see. So when we're taking a look at real estate specifically, I don't really tend to put that much of any money in the real estate stocks specifically, but it's held up relatively well. And you can see just like the industrials and the utilities, the moves aren't as drastic, the swings aren't as heavy as other sectors, and we see this large consolidation. We saw the dump right at COVID, and that whole push for about like 2 whole years. The same retracement that we saw into 2022, consolidation, and then in October to late 23, that pump, but now we're just seeing consolidation again at these all-time highs. So my thought is now, well, within real estate, specifically having an understanding of where interest rates are currently, and the fact that we only expect one rate cut within this year, and I don't know what it will be moving forward. Of course, it's all dependent on data. That's how the Fed moves. So, are we going to consolidate for a year and a half to 2 years like it did here? Right, where we're already seeing that, where we've been in this range essentially since late 28, right? So we're getting up to a year where we're kind of just been in this. Yeah, it's been like a downward trend, but we've been within this range. So do we hold into the end of 2025 within these levels or make a new high, or do we come back into the lower range? I think, or what I see fit is the only way that we go up is if rate cuts happen, and if they happen consecutively. That would then cause real estate to be more affordable in the sense that you're able to borrow more money, or you're able to borrow money at a lesser cost. But in conjunction to that, what you also need to see is a market economy-wide crash in order for the actual price of the asset to decrease, right? Because if if the economy stays as it is, but we get interest rate cuts, people are going to, what is it going to have people do? Like, you're going to have people that are, again, willing to buy up those homes, and they're going to be willing to buy them at the current prices because the rate is lower. So it won't have people shy away. But if you keep prices as they are and prices go down, it's still the realization that, well, how affordable is it really if the interest rate is still going to be that high? So when you get the large run, right, like you did from that COVID drop up to early 2022, this run happened because when this dropped, a lot of people were unemployed, right? A lot of people lost their jobs. You couldn't work. A lot of people lost their businesses. So this point in time, it crashed not the market, but the economy as a whole. So prices plummeted. If you take a look at prices during this specific time, how the cost of a home plummeted in relation to where it was at the high of 2019. And then the run up was because price plummeted in conjunction to rates being close to zero, right? So I think the lowest rate was what, like 2% or something like that. So when you get the combination of those two, that's when you get the extensive run. But then again, you reach a point in time where the supply just dries out. So right now, what we're seeing in the extension is, well, everybody that bought at these lows, what you want to see or have an understanding of is how are they doing on their mortgages? Have they been able to keep up with it? As we feel these new stressors, are they defaulting on their payments, right? And I bring this up because when you take a look at not specifically mortgage payments, but the credit industry as a whole, we are currently in a point in time where, as a country, we have the largest amount of personal debt. So a lot of people, the majority of people are overextended. So what's it going to look like in the next 5 to 10 years when a lot of those come due? Are we actually able to pay it off as a country, or are we going to default on a lot of these things? Awesome. And that is the end of what I had today, or the bulk of what I wanted to cover. Like I said, there's a lot more specifics that we could go into, and the specific charts. but that is something that we'll follow into in the next week, since next week's lecture does cover specifically the sectors like we did today and sector rotation. So that will be a lot more refined and going into the nitty gritty of these things that we started to touch on today. So I want to thank you for your time. I'll go ahead and stop the recording here.